Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. After a long build-up, we have finally reached the point where there is a Boxer pre-listing statement for you to read. These documents are far too rare a sight on the JSE, where we are far more accustomed to seeing firm intention announcements and circulars for companies to go private, to go away, to become uninvestable for us. Although Boxer is not a new concept for investors because it has been part of Pick and Pay, and so you could have learned something about it over all these years, this is the first time that anyone can invest directly in Boxer without having to suffer through the mess in the middle that is Pick and Pay. Think of it as the freshest and best stuff in the bakery, no longer bundled in with that gross-looking donut from a few days ago that no one really wants. It's little wonder then that people are excited about Boxer being separately listed. But why is this happening? Well, precisely because of the gross donut joke. Pick and Pay is unfortunately that gross donut, and they are in serious trouble. But selling down their stake in Boxer, roughly 40% of it, gives them a way to raise between 8 billion rand and 8.5 billion rand from the market. Now, I personally think that they will chew through a lot of that money, maybe even all of it, but time will tell. I'm not bullish on a Pick and Pay turnaround. At the intended offer price for Boxer of 42 Rand to 52 Rand per share, Boxer is envisaged to have a market cap of between 21.1 billion Rand and 24.7 billion Rand. Now, the eventual price here is going to be based on what large institutional investors are willing to pay for the shares. Given the level of interest in this listing, I think there will be quite a bunfight over shares, and I suspect that Pick and Pay will get a price near the top of that range. For the rest of us mere mortals who have to wait until the thing starts trading on the market, it's worth thinking about how the share price might initially behave, along with how it might settle down and then move over time. Now, IPOs are so rare on the local market that we don't have much experience with them in South Africa. In the US, when the market is hot, new listings can show ridiculous first-day gains because there's literally a feeding frenzy around the shares. This is a very good opportunity for traders and an extremely dangerous one for investors. Generally speaking, inflated IPO prices make for very poor entry points into a position. The trick is deciding whether the price is inflated though. Look at WeBuyCars, for example. When Transaction Capital sold down a portion of the stake and separately listed the group, at first blush it looks like a very similar situation to Boxer, but the difference there is that they didn't manage to drum up much in the way of institutional interest. There wasn't this very long lead time. In fact, I think Transaction Capital was quite disappointed with the price they got for their WeBuyCars shares that they did sell. So the listing didn't see much in the way of craziness because there wasn't huge demand for the shares before the time, and hence there wasn't much demand for them as they listed either. Yet despite the lack of a day one pop, the year-to-date performance is a rather daft 92%, and WeBuyCars is now trading on a price-earnings multiple of 24x. I think that is a little mental, to be honest, but it is a great business with strong growth prospects, and I am a very happy shareholder here. Boxer's similarities to WeBuyCars don't end with the way it's been listed and the fact that it's come out of a broken group. They are far more similar than you think because they are both growth assets that are laser focused on a particular business model, looking to own a niche within a broader market. At WeBuyCars, the niche is used cars. At Boxer, the niche is lower income grocery shoppers. The cleverness of these businesses lies in the fact that focus leads to specialization and an ability to do that one thing better than anyone else. Just how lucrative can that be? Well, ever heard of a bank called Capitec? That's a perfect example of what can happen when you get one thing right. Boxer may only have 4.2% market share of the formal grocery market, which doesn't sound impressive at all, but they have 68% share of the discount grocery retail market. Clearly, they are very capable of getting one thing right. So what is it exactly that makes Boxer interesting and special? What might drive strong interest from institutional investors in an offer that opened on the 11th of November and will close on 22nd November? To find out, you need to read the pre-listing statement. If you go on the Pick and Pay website under the Boxer IPO section and you click through all of the compliance screens, you will eventually find a 248-page pre-listing statement. Now, before you absolutely panic, you will also find a 9-page abridged pre-listing statement, which is most helpful. A lot of the information in the Boxer pre-listing statement has been a feature of recent Pick n Pay disclosure, which, by the way, finally started to include Boxer separately, and that is what led the market to understand just how broken the core Pick n Pay business is. And of course, you just need to draw a Pick n Pay share price chart to see what happened next. Boxer is a great business though. It grew turnover by 12% in the 26 weeks to 25th August, of which 7.7% is on a like-for-like basis. Simply put, this means that there is strong growth across existing stores, plus the benefit of opening new stores, which is the perfect combination for a retail group. Can they keep rolling out stores? Well, with a core presence in KZN and the Eastern Cape, the answer is yes, they can. They have exposure to the other provinces, but they have a long way to go, I think, until they reach store saturation point. Now, these are helpful statistics, but they don't explain how Boxer appeals to its core market. That answer is found through an understanding of what is known as a discounter model. This focuses on offering value above assortment. Again, moving away from retail jargon, it just means that the shelves have less variety, but the products are cheaper. If you are counting literally every rand in your budget each month, you care more about price than you do about choice. How can Boxer achieve this? They drive high volumes on a smaller variety of products, and this leads to better volume rebates from suppliers. It means a simpler supply chain as well, and all the cost savings that come with that. And of course, this lets them be really aggressive on price. They also have a high proportion of private label offerings, which means house brands, which can be discounted a lot more than branded offerings. Now, I've been to a Boxer store before, and what struck me is the way that they don't make it feel like a low-income business, even though it is clearly aimed at people who are literally counting every single rand in their wallets. Again, this has always been the Capitec model, so there's another similarity there. Just because a business is aimed at lower-income earners does not mean that they don't care about cleanliness and service and all of the same things that high-income earners care about. A little respect goes a long way in any portion of the market, and especially for those customers who are used to being treated as unimportant in so many other contexts. Boxer understands this, and they do it well. And this is why they can indicate medium-term growth in the mid-teens in turnover, at a trading margin of 5%, which is strong. CapEx is expected to be around 2.5% of turnover, so they should be strongly cash generative, supporting their intended payout ratio of 40% of headline earnings as a dividend. So what does this all mean for the valuation of Boxer? Well, for the year to February 2024, profit after tax was 1.385 billion rand. The guided market cap for the offer to institutional investors, which puts Boxer on a market cap of somewhere between 21.1 billion and 24.7 billion rand, means that we are looking at a PE multiple for the institutional offer of between 15.2x and 17.8x. Now, for reference, Shoprite trades on 24.5x. Let's also not forget that Boxer's PE is unwinding quickly, and I've used numbers that are 6 months old. So in reality, if you actually go through and do all the work to go and do a last 12 months multiple, it's going to come in lower than that, and therefore the gap to Shoprite is going to be even bigger. Now, there are several examples of high-quality local businesses trading at PEs in excess of 20 times. Clicks is all the way up at 32x, so I don't think it would be outlandish for Boxer to get close to the Shoprite PE. Moving above 20 is not out of the question here. Personally, I think Boxer looks pretty juicy at anything below a 20x PE. Above that, it is starting to look fully valued, although that doesn't mean that it still won't deliver double-digit returns and potentially beat the local index. Remember, if a company can return profit growth of, say, 12% and the multiple just stays steady, well, that's going to be your return, and 12% is a very decent return. Chances are that's better than what the index will give you over a longer term. As a parting comment on how much this type of corporate action really costs, 340 million rand in fees. That's the bill that is going to be paid for this listing, of which 263 million is payable to the global coordinators and bookrunners. That's RMB, Morgan Stanley, ABSA, and Standard Bank. And this is exactly why I'm invested in major US investment banks, because IPOs are commonplace in that market, and the fees are literally huge. For the local banks who manage to get on this ticket, this is a rare opportunity to really feed at the trough of capital markets. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.